How does a company build from scratch a fintech for a new breed of financial advisor that serves a new breed of financial consumer?
It's really, really fun when all those years of hard work like start to turn into these milestones that like are literally new almost every week.
And how does a maniacal focus on data position a company to become a custodian of choice for the wealth management industry?
At Altruist, it's very much how the company functions. I'm not swimming upstream when I am bringing data. They're hungry for the data. There's a lot of collaboration and dialogue that happens.
On this episode of Growth Leaders of Wealth Management, I'm talking to Altruist founder and CEO Jason Wenk and members of his team. Harpreet Ahluwalia, or as they call him, Harp, who's their Chief Product Officer, Michelle Schatz, VP of Customer Success, and Chris Hiestand, VP of Marketing. From seeing the industry's problems.
Yeah, I think we always wanted to be a software firm that was solving the core problems that RIAs face.
To surprising industry success.
One of the really strange things about Altruist is how much the advisor community has embraced it without us ever asking them to.
Join me on Altruist's journey to break into the space as one of the industry's premier custodians right now on the Growth Leaders of Wealth Management. Even before creating Altruist, CEO Jason Wenk was an innovator in the wealth management industry. During his tenure at FormulaFolio, it was the fastest growing RIA in the country, growing assets from 0 to 3.9 billion in a very short period of time. Even more amazing, that growth was 100% organic. No M&A, no outside investors. To begin, I was curious to know how he drove that growth at the RIA. Here's Jason.
Obviously, I don't have like the data on every firm that's ever been in existence, but I will say that of those who have been in the Inc. 500, ours is the fastest and the highest ranking ever. It was kind of a cool, proud moment. I think that was back maybe in like 2016 or 17 or thereabout. The formula was actually relatively straightforward. So kind of as I saw it, early in my career, I focused a lot on building software to automate operational tasks. I thought that was the blocker to growth. Like, oh, if you could just open accounts faster and onboard clients in a more delightful way, you could serve more people and you'd have a really great growth rate. And then what I realized after a few years was that actually one of the biggest problems that advisors have is acquiring clients. There weren't a lot of people who developed a reliable, predictable way to get in front of more really good, high quality, good fit prospects and then kind of work them through a process to efficiently onboard them. So the magic, sort of secret sauce at FormulaFolios is that we really invested into two things. So not just the onboarding experience and the automation around portfolio selection, but we invested very heavily in digital client acquisition. So I was very, very early to things like blogging and using YouTube. We, I had a very large budget for things like Facebook ads, and so had a pretty robust performance marketing, platform. And these were all things that I think, especially at the time, these were things we were largely doing between 2010 and 2015. Just very few people in this space were doing it. So it was even more efficient than it is today, right? There was just a lot less competition. So whether you're using paid marketing, kind of driving people down funnel through like a systematic, measurable way, or using SEO, like you just had a lot less people trying to do it. And those were all the things that rolled up into us having a huge inbound engine for demand from consumers. And then we had a really smart way to onboard those people and make them clients.
So from 2010 to 2015 or whatever time frame is most appropriate, you went from $0 in AUM to what? Because I think I was reading one of the articles, it was like 14,000% growth. It was a crazy number.
Yeah, so launched the company in 2012, and by the time I stepped down in 2018, we went from 0 to 3.9 billion in assets, and it was 100% organic. We never bought a firm or anything like that. It was all just like going and opening those accounts. So we essentially opened something like I want to say it was maybe 60 or 70,000 new accounts, and in our best year, our organic net new assets was north of $1 billion. And this was when the market was half the value it is today. So I like to tell people that, hey, doing $1 billion a year in 2015 is like doing $2 billion today. We essentially went from $0 in revenue to, something like 45 million or something. And again, a relatively short amount of time, and did it with, again, no M&A, no outside investors. It was 100% bootstrapped.
That's incredible. And so then tell me about the story of having that success and then coming up with the idea for Altruist. Like, what was that like?
The real genesis was, they say oftentimes companies are formed because we want to, sort of solve our own problems or solve our biggest problems. And when you're growing at the rate we grew at FormulaFolios, every inefficiency was magnified by an order of magnitude or two, because we just were growing so much faster. When you're opening, whatever, 50 to 100 accounts per day, if it takes a month and a half between submitting the paperwork to having the account open, to having the ACAT process, to making the initial investments, your backlog is perpetually sitting at thousands of accounts. And if the not in good order rate, so the rate at which accounts have some type of an issue, if it's 10 or 15 or 20%, again, you're in a perpetual state of hundreds of accounts you're following up on. If you have tens of thousands of customers, inevitably you're going to have many thousands that have contributions coming in automatically each month. You'll have other clients who have distributions going out automatically each month. You'll have thousands of customers with required minimum distributions. You'll have thousands of customers that want to do year-end charitable contributions, some from taxable accounts with specific security lots, others from the retirement accounts, right? So qualified charitable distributions. So everything is at scale, right? It's very painful if something's not efficient. And what really I would say the hair that broke the camel's back for me was I was looking around at where there were investments in innovation, and they just weren't for advisors. It was very frustrating to be an advisor and to watch a platform like Betterment be built, or Wealthfront be built, or Robinhood be built, or Coinbase be built, and seeing how those companies were able to offer lightning fast, all digital onboarding, have accounts open, funded, and invested the same day, not have any need for people or people operations and things like that. So there's just a bunch of inefficiencies, right, that we felt they were quite painful. And I wanted to solve those, right? Now, a lot of the engineers that worked for us, initially the thought was, well, maybe we can build middleware, sort of software. I call it the middle software, where we sat on top of the custodians and we could build our own tools for onboarding, and we could build a bunch of internal tools for keeping tabs on all of the accounts that were in some type of opening or transferring process. And you certainly could make marginal improvements doing that. I even partnered with all of the leading fintech companies, that were designed for advisors, and we spent millions in software subscriptions. And again, you could see some efficiency gains there, but it was nowhere remotely close to the level of efficacy of the consumer fintech apps. So anyway, so that's kind of like the genesis to Altruist. It was essentially like the realization was, in order to get to that level of efficiency of the consumer apps, you had to build the entire stack. You couldn't just operate in the middle layer. So you had to go down to the kind of the clearing and custody infrastructure and build the entire thing, because there weren't really any tools to do that in a B2B, like an advisor fashion.
During his time at FormulaFolio, Jason Wenk developed a reputation as an entrepreneur with a strong vision and a proven capability for growth. But creating Altruist and ultimately building a custodian was an entirely different undertaking. Here's Jason again.
I'd say the very first thing that was different is I knew very early on that this wouldn't be something I could self-fund. So unlike my last company, I could write a lot of the software myself. We could, have a pretty lean team because we were leveraging so much outside technology. It was I think if someone wants to build a TAMP or a RIA or an RIA platform, like you can totally do that without raising outside money. To build a custodian is a totally different, kind of undertaking. And so I'd say the very first, milestone was be capitalized well enough to actually make a go at it, which is not a trivial thing. It's not like this is a friends and family seed round type of thing. I mean, you really have to come out of the gates with, multiple millions or even tens of millions of dollars. The next challenge is hiring a founding team. When you're a solo founder, you can't do that much on your own. You have to go convince people to join you to build something that literally doesn't exist. So there's no anything that you can share with them. They have to, much like the early investors, believe in the vision of what you want to accomplish. And most of the time they have to be willing to take a meaningful pay cut to go take a huge risk to go build something unproven. So those were like the early milestones, was getting the funding and finding that founding team. Many of those early people are still with the company today, and it's very, very cool to kind of look back, a little over 5 years later and see what's been accomplished. And we were able to build up a lot of buzz within the RIA community before we even had a product. So by the time we actually opened the product for alpha release, we had I want to say it was maybe like 600 firms that, collectively managed multiple tens of billions of dollars that were eager to try the product out. And we went into alpha. Again, we're way oversubscribed. We actually only wanted, 30 or 40 firms to kind of have that first access because we knew there'd be problems. And it was really cool because we got to pick from this large growing list. And I'd say one of the most interesting things, and I don't know, maybe I'm hyper biased here, but one of the really strange things about Altruist is how much the advisor community has embraced it without us ever asking them to. Meaning, I don't know any other company that gets quite the level of like shout outs where advisors just kind of go on social media, they talk about what we do. I remember the first conference we showed up to, and we had T-shirts. I mean, people were like changing behind the drop cloth backing and putting on the new shirt to walk around with their Altruist shirt. Like, we just, very quickly kind of built a little bit of a cult following, and that wait list grew from, again, let's call it 600 to 1,500. And by the time we came out of alpha and into beta, and then eventually launched the product, which was only about 3 years ago. We had thousands of advisors on our wait list. And you can't do much with a wait list, but again, that was a big milestone to know early on that product market fit only happens after you've launched your product and people use it enough to generate revenue and you're able to prove out the economics. But before you're able to get there, it's very encouraging to know that the advisors want something better and they're very eager to see what we could do. And they really were embracing kind of the way we're doing it. So those are some of the early milestones. From that point to today, it's like literally drinking out of a fire hose. So from launch of the product into full release till today, we keep a lot of our data private, just given that we're a venture-backed company. You don't want to keep some data close to our chest. But what I can say pretty confidently is that in those first 3 years, there were more assets that were added onto the Altruist platform than every other fintech company in the United States combined. Wow. Right? So take Robinhood, Betterment, Wealthfront, M1, Stash, Acorns, all of them in their first 3 years, combine them, and then still maybe even have to add another 50%, right, to achieve like the level of growth Altruist had in its first 3 years. So I don't know that advisors fully appreciate that, and I don't think the industry fully understands that to some degree. Like, because it's easy to kind of go, maybe you guys are like the same size as some like a financial planning software app or some other fintech app, and then it's kind of like, well, custody's a little bit different. Custody is very big. The incumbents are $100 billion companies. In Fidelity's case, they might be a couple $100 billion company. So these are just very different sizes and scale of companies, and so I wish I could say there's like a single milestone, but it's one of these things where I would say that, you hit the first billion or something in assets and you're like, yeah, that was really cool. But, that's not enough. So you have to wait till you get to 5 billion, then 10 billion, then 50 billion, then 100 billion. So the asset growth, it takes a little while for the momentum to build, but it really, really compounds quickly. And now that it's in the market, we have very clear and obvious product market fit where our kind of flywheel of advisors coming on and opening accounts is highly measurable and scalable. And yeah, so like the sky really is the limit. And every day, in fact, just last month was another new record month. And then that was following Q1, which is a new record quarter, and so we're at that fun stage of a company. This won't last maybe forever, but anyone's ever built a company, it's really, really fun when all those years of hard work like start to turn into these milestones that like are literally new almost every week, where you're just setting new record after record after record. Eventually that tapers off and becomes a bit of a norm. But for us, it's just really exciting. Every day is really exciting right now.
How do you manage that type of growth as a leader?
Well, it's not easy, and I make a lot of mistakes. And I oftentimes, have to remind the team that I make the best decisions I can with the information I have, but I reserve the right to change my mind at all times because I know I'm going to be wrong. And in fact, the whole company, we're going to be wrong a fair bit. I think it was Jeff Bezos. He made a comment. I'll paraphrase it, probably a bit bad, but it was something effective like, if you're able to learn from mistakes and pivot quickly, mistakes will have a very small cost. If you never take any risks, you'll almost certainly have a high cost. So like you'll miss so much in opportunity, and that cost will be super high. So we kind of operate from a place of understanding that it's going to be hard. We'll make some mistakes, and that's okay. There's times I think of lately, like we had a pricing change. We executed it really poorly. We pivoted really quickly. It turned into a massive win for us where we were able to really think about that and go, how do we objectively have the best pricing in the industry? And that only came about because we made a mistake in just how we sent out a pricing update. It made us think harder about it. So our general mentality in leading the company, myself and other leaders, is just one where if you have incredibly bright people that work on high agency, you have to be able to, if you're going to move quickly and compete against much larger organizations, you're going to be willing to give up control. And if you're going to give up some control, which is totally okay, that's effectively saying, I will grant others certain amounts of authority and autonomy, but I'm going to hold them accountable to it. And I think just a mistake for most companies in general is trying to hold people accountable, but not actually giving them any responsibility or agency. Mm-hmm. So I see that all the time.
And speaking with Jason about how he built Altruist, I was struck by many things, including his unusual approach to hiring talent. I offered him my understanding of his method so he could expand on his ideas. What I heard from you was you think that it's interesting that so many other wealth management firms only look for talent within the wealth management space because those people bring an inherent bias to their work because they've always sort of worked in this space. And so you've intentionally looked for unconventional hires, people who have held positions in the position that you're looking for in external and other industries because you know that their capability in the function is actually what's going to drive the most success for Altruist. So that's really interesting to me. So I'd love to hear a little bit more about the approach that you take to build your team.
I would say that one of the things about our industry in general is if you've been doing this for a really long time, everything starts to look like gray paint. And so you just have hundreds of different shades of gray paint and nothing really stands out that much. And so we end up becoming a bit of an echo chamber, of just opinions that are largely the same. And it's hard then to innovate and create really great businesses, great products, market well, innovative go-to-market motions and so forth. So I think one of the things that I've found to be incredibly helpful for Altruist is finding the right blend of subject matter experts with people who from entirely different industries or industries that are a little bit adjacent.
To give you an example of that blend of insider and outsider expertise, the COO of Altruist, Mazi Bahadori, had both fintech and traditional financial service experience when he was hired. Alternatively, Harpreet Ahluwalia, or Harp as he's often called, was hired having never used a financial advisor before. He's currently the Chief Product Officer for Altruist, but his background was as a product leader at places like Salesforce and ServiceTitan. He didn't bring any personal bias toward the wealth management industry, so his problem solving comes from a place of first principles. Instead of saying, this is how we did it at my last financial company, he would instead ask, what's the best way to do this? Here's Jason again.
So you can imagine today we have almost 450 people, and specifically on the areas of product and development, probably 90% don't come from financial services. I mean, they're just really brilliant designers, really brilliant product thinkers, really brilliant engineers and architects. We took a similar approach to go-to-market. If you look at our entire go-to-market team, it's really interesting. You have, go-to-market in its most simple form for those who aren't super familiar, right? It's all of the marketing that drives inbound demand. It's the sales team that kind of converts that demand into paying customers. And it's the customer success team that sort of enables, really delightful experiences and service.
The marketing and customer success team at Altruist is also quite unique. There's Chris Hiestand, the VP of Marketing. Before working at Altruist, he was the first marketing employee at Hims and Hers, which sold products like hair loss pills, primarily through Instagram. On the surface, the industries couldn't be more different, but Chris has an aptitude for using market-driven data to drive customer demand, exactly what Altruist was looking for. And Michelle Schatz is the VP of Customer Success. She came to Altruist with prior experience working on a B2B2C platform, but in the medical field, not the financial industry. Hiring outsiders like Harp, Chris, and Michelle has successfully sparked new innovation at Altruist.
If you look at Altruist, I think we were the first ever custodian to offer in-app chat, where if you just want to click a button and chat with a live customer success rep and have them be online typically in like 20 seconds or less, you can do that. It's actually incredibly efficient. And once people use it for the first time, I think the majority of advisors go, yeah, most interactions, that's way faster and easier than picking up the phone and calling, getting transferred to somebody. And then how do you follow up on that? Like, whereas a digital approach, you get an automatic kind of ticket number, there's email follow-up, it's all saved in the system. So you have this perfect audit trail of your service experience. You're able to give quick feedback so we can actually rapidly, hey, your session finished. How was it? Scale of 1 to 10. Was it 8, 9, 10? So we can very quickly measure like who's doing well and our customers happy with, like where are we failing? Like where can we get better? These are kind of simple innovations in a lot of respect, but they just weren't done in our space. And they wouldn't have been things I could have ever come up with, right? So I would have butchered our go-to-market motion. I would have butchered our sales process. I would have butchered our CS in comparison to what these people brought. And they came in with, again, zero experience working with financial advisors or working in wealth management.
Diverse hiring is a core value at Altruist, but so is a maniacal focus on collecting and effectively using customer data and feedback. It's been that way since the very beginning when RIAs helped inform what type of product Altruist would ultimately create. Here's Harpreet Ahluwalia, Altruist Chief Product Officer.
We always wanted to be a software firm that was solving, the core problems that RIAs face, and we interviewed a lot of RIAs at the beginning, and also did surveys, and I think we learned that there were sort of three main problems that they had. One was the very manual and paper-based process of onboarding clients. The second was, all these disconnected systems that didn't talk to each other: CRM, financial planning, performance reporting, billing and invoicing, risk scoring, rebalancing. And I think not only were they disconnected, but also high cost of just cobbling together all these solutions. And then I think the third was around customer acquisition, not really efficient ways to find new clients and bring them on. And so we really sought out to solve those problems. And I think along the way, we knew that we would have to do a really great job of solving these problems. We'd have to become a custodian at some point. But that was more a means to an end as opposed to like where we started. We really wanted to build this amazing tech platform that allowed advisors to digitally serve their clients and bring a lot of these disconnected solutions under one umbrella.
And those are big problems that you're talking about solving, from, having a digital experience, no more manual paper-based, bringing together disparate and disconnected systems, helping advisors with customer acquisition, which is just a huge need and large problem in our space. Go back to the beginning. Like, how do you even tackle that? Those are such huge problems. Like, where do you start? Do you try to tackle them all at once? Is it more sequential than that?
Yeah, I mean, I think we started by really deciding who we were going to build for initially. And, I think we landed on what we call our ideal customer profile. And that was typically an RIA that was less than 100 million in assets, usually younger, early on in their career, very interested in using technology to scale their business and to serve their clients. We found a lot of them were affiliated with, some communities like XYPN, and, we just started interviewing them. And I think in the first 3 months, Jason and I met with a couple of dozen of those advisors, and, we had a thesis of what the MVP or the minimum viable product would look like for that audience, and I think we landed on letting them custody primarily at TD Ameritrade, and then bringing in that data and using that to surface insights about their business and their clients, and then helping them do really elegant performance reporting and really automated billing and invoicing. That was sort of the first part of what we launched with, and along the way we got a lot of feedback. We almost were able to co-create that solution. We showed a lot of mock-ups and designs, and got those early customers really involved and become early adopters. And it was free to use. I think we were just looking to learn and not just build like a revenue business. Like, we wanted to find product market fit, and I think we were able to do that quite quickly by having a really narrow focus, both of who we were going after and what problems we were trying to solve for them. After we solved sort of the performance reporting and billing problem, we were able to get into other things like investment management and portfolio management, clearing and custody, client portal, and our goal is to get into even additional workflows for these RAs, like marketing automation and lead generation. And so, very similar approach of like, let's solve a few key workflows for a very narrow segment, and then we start solving more and more workflows, and then we start expanding into adjacent segments like breakaway RAs, larger firms, which we call SMBs or enterprise. And so, I felt like that's sort of the vertical SaaS playbook, where you start small and then you start to kind of solve all the problems for that one vertical.
One place of both challenge and opportunity in the industry today is lead generation. I asked Harp to explain Altruist's approach to lead generation from a product perspective.
Our goal eventually is to have a marketplace where interested clients can find a good fit advisor through Altruist. And I think what we can bring to the table is a lot of data about advisors, because they're on our platform. And we, as opposed to just a standalone marketplace, we know a lot more about those advisors. We know who their clients are, how fast they're growing, what their investment strategies are. And we're also uniquely positioned to get real credible testimonials or reviews from their clients, because those clients are also on our platform. So it's almost like, I don't know if this analogy makes sense, but it's almost like a Yelp versus OpenTable. Like, on OpenTable, the reviews are from actual diners.
Yep.
And on Yelp, you don't really know who's saying what about the business. And so I think that would be sort of our approach, is how can we, using the data that we have about advisors and collecting the right data about prospective clients, find the best match. And that's something would be that would be our approach to lead gen.
So now we know collecting data and using it well is another core company value at Altruist. So is maintaining a growth mindset as the business expands and innovates. I asked VP of Marketing Chris Hiestand to describe one of the biggest growth lessons that he has applied successfully.
What you want to do is you, right off the bat, want to be solving a real and painful problem for your audience. So after that, I think it's just really your complete offer. So like the product matters, the packaging, the pricing, like you have to just nail all of those fundamental things, and you really can't like skip over anything. I think too frequently it's let's just spend our way to growth.
I know that Jason was really proud when I spoke with him. He said, we only spend $1 million on marketing, which is super limited in the broader wealth management context, given Altruist's just like exponential growth, right? And as Jason said, that spend is really driving more inbound demand than Altruist can handle at this point. How does that work?
Yeah, that's a good question. I mean, Jason's right. Our strategy is predominantly inbound. So it's like the channels that you would expect. In general, I think we look at our digital channels. We've gotten much more efficient year over year. It's driving more pipeline at a more, efficient and lower cost. But I think more importantly than really the channels and where we're investing the marketing dollars is just focusing really on our product. So, we do a lot to just make sure that the product continues to meet the needs of the audience, addresses those pains that we were talking about, which I know financial advisors have a lot of those. So we invest in the experience. So, make it the best product possible and make sure your service is world class, and then listen to that feedback and just continue to get better. If we do those things, which we have been, then that generates just a lot of positive word of mouth. And that really creates a really nice growth flywheel for us.
And from a channel perspective, when you're thinking about what worked in that direct to consumer space, do all the same channels apply in an advisor space, or is it different? What's different?
No, it's definitely different. I mean, it's a much smaller market. I think since it is more of a targeted market, and like all of these advisors, everyone kind of knows one another. They're going to the same events. They're going to the same conferences. You just really want to nail that product and the experience and service, because like getting that word of mouth going, like super critical for B2B businesses. There aren't millions and millions of independent RIAs that we can market to.
And I'd be curious to hear the way that you think about sort of messaging, positioning, and sort of staking a claim in the advisor space as to like who is Altruist. So knowing that Altruist launched as a tech platform for advisors and originally didn't have custodian clearing. And so there was sort of this like, where does Altruist fit? Is Altruist a tech platform? Is Altruist a custodian? Who's Altruist competing against? But has that played a role at all into sort of how you think through brand and messaging and positioning and how you show up, where you show up?
Positioning is context. So like you want to provide the right context to your prospective customers. I think I joined August of 2022, and like we were still very much in that kind of like platform stage. Like we called ourselves a custodial solution, right? Or a custodial platform. Making that move to self-clearing and being able to like put our flag in the ground and be like, no, we are a custodian, and like here's how we're different. We're a modern custodian. Like we prioritize things like building technology, like being innovative, like speed and efficiency. Like all of these things are priorities for us. I think that was pretty critical, actually, and just like being very clear. If you're an advisor and you're thinking about breaking away and setting up your own RIA, you have a consideration set of custodians that you're probably thinking about. If we're not putting ourselves out there as a custodian and actually differentiating like against the other players in the space, then like how is an advisor going to know to have us in that consideration set? So to me, like I think that was a pretty critical moment in the company's history when we went self-clearing and we're able to actually say like, yes, we are a custodian, obviously vertically integrated with all these other great technology tools that you can use to run your practice efficiently. But I think that was a big moment for us, and something that we're always looking at. Just as we go forward, we're always looking at our positioning and just making sure that we're showing up in the market the best way possible. The largest amount of data and the most helpful is actually just listening to the feedback of our customers. Internally, all of our customers have access to an ideas board. It's basically like an internal roadmap. It's a very active and engaged community, and advisors are constantly giving us new ideas. Other advisors are able to go in and actually upvote ideas that they find super helpful. So, for us, like paying very close attention to that, just making sure we're talking to those advisors on a consistent basis. Like for us, that's the most critical data. I truly don't see other custodians like operating the way we do, and that we exclusively build for RIAs and we actually try to co-create with them as much as possible. So, actually listening to the things that they're asking for and delivering on those things. So I think for us, the biggest opportunity will just be continuing to innovate, continuing to listen to our customers and letting that drive our product roadmap. So I think the future is very bright.
Paying attention to customer interactions is an important part of the customer success division at Altruist. Like other departments, they use first-hand data to improve the customer experience. And they also operate with a growth mindset, making sure that operations are efficient today and scalable for future growth. Michelle Schatz is VP of Customer Success.
So my role specifically is to look across the customer journey and to think about where a human interaction makes the most sense to enhance the customer's experience with our platform to get the value proposition that we talk about, right? That spans across a couple different areas. So you have marketing kind of further up in the customer life cycle. Then you have the sales kind of function in the customer life cycle. And then you have my team, which comes in from an onboarding perspective. And then once you've graduated from being in an active onboarding state, then there is the ongoing support, service, relationship management that's going to happen with that customer. And then we work very closely, my function works very closely with every team that interacts with customers so that we're operating in a consistent and cohesive fashion. The worst thing that can happen when you're interacting with a customer or service from a customer service perspective is to run into amnesia. When the customer sees us, Altruist, and is interacting with a representative from the service team in any capacity, they're not looking at that person as, oh, you only see this slice of Altruist. That you are the human face and voice of the brand. And the expectation is that you can cohesively look across all of the different functions at the organization to help them accomplish what they need to accomplish. So we need to make sure that when we're structuring and thinking about our service models, that we're looking at it from that perspective. And then as far as the impact of the growth, like what has been my contribution to the growth, I think one of the things you have to really think about is when you're starting to build something from practically nothing into what it, something that's much, much larger, very significant, you really have to think about starting with generalization and folks that can wear many, many hats and do many, many things and do them very, very well. You tend to have a small population of people who can do that, where you can control the consistency and they can just do all of those things. And then as you gradually go through the growth journey as an organization, you hit different inflection points where then you start adding more focus into people's roles within the organization and more focus at different parts of the customer journey. You can maintain the consistency of what's happening. As our product expands, as the customer segments we service expand, we have to think about the adding more focus in, but you don't start there, right? You think about the end game you need, and then as you hit different inflection points, then you start to create more focus and more focus. The trick is that as you're thinking about it and as you're doing it, that you don't start creating fragmentation with the focus, right? So it's a very fine balance as you're going through a growth journey to think about those things. So one of the things that happens in service organizations is what makes a delightful experience, right, is not just that the person provided you a factual piece of information or answered your specific question, but that they actually had an open-ended interaction with you and thought about what problem you're truly trying to solve. And so we don't want people to get into these modes of being factual and friendly, because that's a lot of the service you get. It's very factual and friendly, but you're like, are you hearing me?
Are you helping me?
Like, are you actually helping me? Are you actually thinking about my problem? So it's key to have people that have high curiosity, high agency, very self-directed. Once we find those individuals and then we put them through our program, what we think about is making sure that people get a general swath of everything that's going on. The most important thing is to teach them how to fish. So there's more than they'll ever be able to actually master and hold in their heads. And so what we really have to think about is how do we have the information, the knowledge, the help articles, the standard operating procedures and whatnot centralized and available so that no matter what the team is doing, if they don't know the immediate answer, they know what path to take to get to the answer, so that they can actually assist the customer without the customer having that fragmentation of having to ask 5 or 6 different people. It's the one area where we've brought in AI where we do have some AI search tools sitting on top of our knowledge repositories so that we don't have to have the team fragmenting their thinking about where do I go to find this answer. They can start with the AI search, try to zero in on what the most correct answer is. And then, of course, we, even ourselves, have other humans that are available to help
Sure.
as well. But over time, as I mentioned earlier, when I said, like, as you progress as an organization, you're going to continue into thinking about creating more focus and specialization. As we progress, we will move towards offering or thinking about what dedicated models make sense. And also, how do we route questions or how do we get questions most directly connected to the person who's best equipped to resolve or address an inquiry? A real recent example of this is we just automated the way that we intake secure file uploads that people are sending us. We revised the way that they get processed so that they automatically get routed to the team that's actually going to process it. No more middleman through a support person who takes your request, has to package it all together, pass it to another team, and then you have that potential delay. And no middleman who isn't the most expert person telling you whether it's in good order or what might need to be corrected. You're going right to the source for that. So we really look for, in everything we do, any instance where there's not a value add and it's just like, playing a game of telephone. We try to remove that. The goal is to remove as much of that as possible. And as you continue to grow, you just shave more and more out as possible. One kind of note on that, when I really think about what Altruist is trying to accomplish, right? Democratize the availability of financial advice, meaning that financial advisors can afford to service the people that need to be serviced, that are looking for service, who may have been underserved. And those that are underserved or not able to find it can find it and connect and do that in an affordable way and drive these great outcomes. There's no way that we're going to do that if we aren't wildly efficient with where we put human capital. And what I mean by that, and human capital sounds like such a clinical term, but it's the most valuable and beautiful thing that we can offer. I really only want somebody asking me how-tos that are complicated, right? And really specific. Somebody reaching out because they're like, where do I send the check? Not a major value add for that person either, right? And obviously in situations where they're reaching out because something, if it's genuinely broken, obviously we want to mitigate that altogether, right? Like that's never, you don't want them to reach out. But when they're reaching out because they think it's broken, but it's not, it's a lack of understanding of how it works, those are huge opportunities for us as an organization to ruthlessly cut out non-value add interactions. So when I think about what my team is doing, they're also this huge listening engine of how do we distill all of our interactions. And we have a ways to go. We're not there yet. But this is the mindset that we're operating from, is how do we distill those interactions to be the most value add possible so that it's maximizing everyone's time and it maximizes our ability to be in a position to serve a very large breadth of different advisor segments, RIA segments, that wouldn't be able to be served otherwise.
Data informs every aspect of what Altruist does. So I asked Michelle which metrics inform their innovations and how do they know if the changes they make to the customer experience are working as they expected?
We're going to look at our SLAs. We're going to look at our customer satisfaction scores. We're going to look at net promoter scores, right? We're going to look at those. We're going to look at the quality checks that we do of interactions. So we're also quality checking our interactions. Those are the typical suspects. Some of the other metrics that we look at, though, is I'm also looking at the average number of inquiries per different types of customer segments. And I want to make sure that that number is actually going down over time or staying flat. If that number continues to grow, then my team has to exponentially grow with every new customer that we're adding.
Right. And then you can't reach that
to the
wild
platform.
efficiency with human capital that you spoke about.
Exactly. But we have to be really mindful because right now the company is in a hyper growth state, right? So we don't want to short circuit growth you don't want to do scale at the sake of growth. At the same time, you do still need to be cognizant and mindful of it. And if you're not paying attention to it, and then you just come up for air and then think you're going to pay attention to it, that is usually where companies stumble, especially like newer type startup who seem really successful initially. They will hit a wall where it's like you pass the inflection point of when you should have been thinking about some scale measures, some thought to what does it take to actually, what is the cost to serve? And so we do look at what is the cost to serve, and ensuring that the return is there both for the customer and for ourselves as well. Value add interactions with customers that are growing and help them grow and see the value proposition are great. But when both sides or either side needs to have a lopsided amount of interaction, that is a sign that maybe something's not great. So we look at all those metrics. We definitely look at the health of the firms that are with us. Are they growing? How often are they interacting? What's the nature of the interactions? We do a lot to understand, not just, it's, if you put it in human language terms, if I was to tell a story, I always want to know, well, why are they reaching out, right? How often do they reach out? Why are they reaching out? How well are we doing at addressing their concerns or their needs when they reach out? And how many of those instances are value add that we should continue supporting versus eliminating for both sides?
It wasn't just about getting it right. It was about changing the paradigm, something the industry needs in so many ways, and certainly from a customer success perspective.
I'm not swimming upstream when I am bringing data. They're hungry for the data. There's a lot of collaboration and dialogue that happens. Obviously, we have an enormous, list of priorities that we need to get to, and there are those resource constraints that you need to work through. But I really feel like when I stepped in, I think the one thing that was a genuine shift for me was that they were so actively listening to what the customer success organization had to share about what was going to create a successful long-term growth with our RIAs, with our customers, towards our mission.
Before we end today's show, let's zoom out and tackle a topic rarely discussed by today's leaders in wealth management, but really important from the lens of growth. I'm talking about unit economics. Unit economics can help people create something really big, like a well-funded, high-growth business. And it can also help on an individual level, like when a financial advisor is acquiring a new customer. I asked CEO Jason Wenk to break down unit economics for us.
So unit economics, for those super unfamiliar, it's essentially what is your cost of acquisition? So what does it cost to acquire a customer? And what is that in relation to the customer value? And then probably one other metric that's key. There's lots of other metrics, but one other thing that's key for us is your payback period. So to break those down, cost of acquisition, if you're marketing and paying for marketing, it's the cost of the marketing. If you're paying for a salesperson, it's the cost of the salesperson. If your product has a deviation from gross profit to net profit, so let's say, for example, if your product was a cash product, like we have a cash product, we pay 5.1% to our customers, but let's just say we earned 5.3. Well, the 2/10 of a point in the difference is kind of like part of our gross profit, but our cost of goods sold is the 5.1. It costs us 5.1% of the 5.3, right, to generate that 2/10 percent. But the more simple way is just like cost of marketing, cost of sales, cost of onboarding. Like that is your CAC, cost of acquisition. LTV is very simple. It's the revenue you earn from a customer over their entire lifetime. If you have great retention, like 98%, you just take, like 50 years literally worth of like how a customer might expand over time and what that revenue is. And your CAC to LTV ratio is essentially like, how efficient is your business? Like if you can acquire customers for $500 that are worth $5,000, that's really, really good. The other magic kind of metric that I like to look at is payback, because that'll help you understand how fast, essentially how capital intensive your growth rate will be. So payback, again, is just If it costs me $1,000 to acquire a customer and it takes 1 year to generate $1,000 of revenue, my payback period is 12 months. So good metrics would be like a CAC to LTV ratio, where if you can get 10 to 1 or 15 to 1, like that's really, really, really good. Altruist would be well beyond that. So we are, because again, part of it is because when you choose a custodian, most people stay around for a long time and they expand over time. They open more accounts, their customers add money, the market grows. So over decades, you can earn hundreds of thousands or millions of dollars in revenue for a cost of, maybe, some fraction of that, right? Certainly well less than 100,000 in most cases. And then the payback periods have been pretty short too, right? Because if you earn, again, whatever, let's just say $50,000 in revenue, and your cost of acquisition is $30,000, it only takes about 10 months, and in our case, we tend to average somewhere in the like 12-month-ish period. So it just means that we don't have to raise hundreds and hundreds of millions of dollars because we have to wait 5 or 10 years to be paid back. A lot of the robo-advisors, like that's kind of what went wrong with them, is that you'd kind of look at the unit economics and you'd go, yeah, over 20 years, it's a good profitable business, but it might take 10 years just to get to break even. And so they have to be able to finance 10 years of client acquisition before it actually starts paying back and generating, GAAP profitability. And so nice lesson, even advisors should know these metrics.
Right.
If they're acquiring customers, they should totally know, well, what does it cost to acquire one? How much time does it take? How long do you pay back? This makes it a lot easier to think about, when do you add new staff? When do you,
how to make decisions.
Is it sensible to have paraplaners? Totally, I think we teach a little lesson on this. We have these events called Altruist Academies. I actually teach a little lesson on like advisory unit economics, because that's, if I was to say I have something I'm very good at, it's kind of a running joke for my exec team, but I'm like a amateur mathematician, I guess. I love the math of this industry. It's kind of how I got into it. I didn't start as a financial person. I was an engineer, math person. And this business, it just works perfectly for people who think that way. And the unit economics, generally speaking, if you perform reasonably well, are extraordinary. And that's why when people wonder, why is all this private equity money pouring into the space? Well, it's because the economics are very good in this space. You get lots of recurring revenue. It compounds over time. Payback period is relatively short. Even if they do bad M&A deals, their payback period is going to be much better than a lot of other industries. So I would encourage ambitious entrepreneurial advisors to do a few lessons on unit economics and then put it to practice, and they'll build a great business.
We've taken a deep dive into how Altruist came to be and where it is today. Now, where do they hope to go from here? Here is Harp once again.
Yeah, I think for the last few years, our focus has been to build out enough of the platform that we can be competitive with the incumbents in this space. And so it's been, obviously we want to build better features, better experience, but we also needed parity. We needed to check a lot of boxes that would, potentially block customers from switching from a Schwab or a Fidelity to Altruist. And I think we've come a long way in that journey. And so now I think it's much more about the scaling and having high quality. So I think one of the things we're really focused on is making sure our architecture can scale and that we can serve larger firms and more AUM on our platform and do it with high uptime and high degree of quality, and then also go deeper into some of the features that we built. I think there was sort of a race to parity for a while, and now that we're pretty much there, we want to be objectively better in each area of the product. So I think we're already really, the superior solution in terms of account opening. And so, but how can we get better there? Like, is there an opportunity to use AI to, even open accounts faster? Is there an opportunity to bulk migrate accounts? So I think we're taking each area that we built and trying to figure out like how can we get better and deeper in those areas. And so I think our org structure is evolving. So I think we've sort of organized our product and engineering teams into much smaller units that can go deep into an area, understand the user metrics, and figure out how to improve those metrics. So, for example, how can we make account opening even faster? How can we reduce the percentage of accounts that go through a manual approval process? And so, I guess to answer your question, preparation for the next 3 years, we're also thinking about like what is the org structure that allows us to innovate in each of these lanes. Because now that we have these established lanes, it's no longer about, just parity. It's about going deeper and being better.
And to wrap this episode up, let's hear from CEO Jason Wenk on the future of Altruist.
I like to separate commercial success and then personal, like mission-driven success. I think although I'm a math person and I'm very proud of the sort of math behind Altruist, it's partly why we've been able to attract great investors and capital and talent and grow a very meaningful business. It all started with the mission, which was make advice better, more affordable, accessible to everybody. And this kind of goes all the way back to when I was growing up. I grew up in an area where nobody really had money, and there certainly weren't any financial advisors around. I think over the last 20 years or so that I've been in the industry, by and large, what we've seen in America is a wealth gap widen. The rich keep getting richer, middle class is evaporating, poor are getting poorer in relation to the rich. And so all the innovation, right? People could make whatever arguments they want, but at the end of the day, like objectively, we're failing a bit in wealth management. We're even failing in fintech because people are creating applications that give access that doesn't help people get ahead. So access, like the democratizing access to finance type of mission, doesn't really work unless you're democratizing access to something good and helpful that actually gets people ahead financially. I've always believed, ever since I got exposed to the RIA space in 2004, I was like, gosh, if you could get these fiduciary financial advisors and make them a lot more accessible so that whether you have $10,000 or $10 million, like you can get really good high quality advice at a fair price, that will change the world. And advice has largely either been out of touch, like meaning way too high of minimums, or people have to sacrifice quality in order to kind of serve a broad set of clients. And in general, the costs are still just too high. Like market returns long term, let's just say that they're 10% or 9% or something at best. If the cost to get that is 1% or 1.5%, like that is just a really bad gross margin for the customer. So that's really I think the long-term success of the company will be if we achieve or make improvements, like if there's a demonstrable way where we can say we've helped millions of people get access to advisors that otherwise wouldn't have had access. We've helped maybe thousands of advisors launch and grow their own independent business that maybe would have had a really hard time doing it without us. Like that's success. And I have no doubt that there'll be tons of commercial success too. But the one that will matter the most is if we're actually achieving that mission. So if we don't, then we're just gonna be one of many other fintech apps. There's lots of them out there that are commercially successful but not helping people. We don't want that. That'd be pretty disappointing.
Altruist's mission to make financial advice better, more affordable, and more accessible to everyone continues. After my time speaking with the team at Altruist, here are my top 5 takeaways from the company's journey so far. 1, if you're building a business, especially one with rapid growth potential, you have to solve problems along the way. Rapid growth can magnify every inefficiency. So pay attention to the data and to the day-to-day operations and make the necessary adjustments. You don't want to short circuit your growth potential, but you also need to be mindful of it. Companies that don't pay attention often stumble. 2, when creating something new, you might need to build it from the ground up. Altruist could have drawn on existing technology when creating their platform, but early on they realized that to attain the level of efficiency they wanted, they needed to build the entire stack. That meant going down to the clearing and custody infrastructure and building the entire thing. Operating in the middle layer was just not going to bring them the results that they wanted. 3, use your data. Identify the data most useful for shaping your product and your ideal client, then employ that data across every facet of the company, from development to marketing to customer success. Also, listen to feedback from your customers. That could be some of the most helpful data available to you. 4, have a clear vision. Really identify the problem you are trying to solve and keep that mission at the center of your development across all departments. Altruist is here to serve a new breed of advisor and consumer. By being very intentional about that mission, Altruist has positioned themselves to be an important custodian in the years to come. 5, look outside of the industry for innovation. It's easy to be focused on finding talent that understands our vertical, but often that type of talent comes with assumptions that can hamper new ways of thinking. By intentionally looking outside the industry, Altruist was able to build something genuinely innovative in a space that badly needed to be shaken up. Altruist's journey to build a fintech forward custodian to support a new breed of advisor and consumer continues. I'd love to hear your takeaways from their journey as told on this episode. Find me on LinkedIn and let me know. You'll find a link to my profile in the show notes. For more from the Growth Leaders podcast, as well as lots of valuable growth insights from FICOM, go to ficompartners.com/insights. Join us for the next episode when we'll be talking to Choreo. Until next time, I'm Meg Carpenter, CEO and founder at FICOM Partners and your host of Growth Leaders of Wealth Management.